Good morning, everyone. Welcome to our weekly macro meeting from the Goldfields Fund. This is the 19th of January, already on the third week of January, huh? Time flies. Today we are observing Martin Luther King holiday in the USA, so markets should have lower volumes, but during the weekend, Trump made some threats of raising tariffs again on Europeans, and the market is stressing a little bit on that. The indexes are falling something close to 1%. And so we have some subjects to talk about, new studies that we made regarding the dollar real and other interesting stuff. So let's begin with no further delay. Okay, so just a brief uh, brief sum up of everything we have. Martin Luther King Day, tariffs are bringing some de-risking. Fed independence and potential personal changes move sharply to the fore this week. Once again, with I think the story of Lisa Cook and etc. Incoming data, as we will see later during the presentation, suggests strong growth and soft CPI. But JP Morgan says they are tracking firm December PCE inflation, probably due to stronger economic data and activity. Today we also had GDP for China. It was slightly lower than expected, especially retail sales, but it was just a tad miss. The numbers were still strong for an economy of such size, 4.5%, even though it slowed from 4.8% in the third quarter. The PBOC was doing some stimulus. They stopped for a while. We'll see what happens. What is calling our attention today is more Japan. The long yields really seem to be getting out of control. The 10-year last week on our last meeting, the 10-year was trading at 210 and now it's 224. 30-year was 340, now it's 360. So it is a worrying situation here because even though they have a shrinking monetary base, shrinking nominal GDP, and rates going up, skyrocketing like this may cause an economic crack in the near future. We don't know what may happen. This will probably be some source of volatility in the future. So we have to be very watchful of Japanese data from now on. And Brazil once again on the political on the spotlight with political things. Trump suspending the issuance of new visas to Brazilians due to Brazil having commercial relations with Russia. And once again, as we said last week, IPCA number came uh, close to the central bank target. At least was within the band. The target is 3%, and the band is 1.5% higher or lower. So 4.26% is still lower than 4.5%, which was the upper target band. Okay. So no further delay. We start with the USA always, biggest economy in the world, and we have been watching. I think that JP Morgan made a very good uh, resumption here about what are the possible scenarios that are developing for the American economy. We have the upside scenario, as they call it, which I agree, where Fed cuts rates while inflation remains in check and growth is resilient. This is exactly what is happening now. We see inflation numbers, at least current inflation numbers, slowing down. Implied inflation numbers were slowing down up to last week. This week they are rising a little bit. This is like Goldilocks-like scenario, good for equities, good for risk assets. They also have this base case scenario where economic weakness and where there is economic weakness and the Fed continues to cut rates. And third but not less, downside scenario where the Fed is cutting despite inflation picking up. Then the Fed loses credibility, and this one would be bad for risk assets, okay? Especially for equities and bonds. Well, bonds are not risk assets, but they would suffer in this scenario, okay? Going forward to liquidity watch, according to Cross-Border Capital, global liquidity rose again last week, but the pace of expansion is clearly slowing. The 3-month annualized growth rate has slipped further to 1%. The continued rise in annual growth rates reflects weak liquidity growth in late 24, early 25. So here we have a situation where liquidity is still growing, but at a much slower clip than it was growing before. So something to start worrying about, especially because the market is trading close to its highs, so it becomes more vulnerable. We know that the Fed has acted on the last few days to cap stress on the SOFR versus federal funds target rates, the money markets. So this is the measure of overnight funding with no risk, with public bonds, government bonds, which is the SOFR, against private collateral. Whenever the spread is too high, we know there's a funding. The market is it is looking for liquidity, and the price for private collateral is going down, for public is stable, and then we have the spread gaping. And so the Fed acted quickly and managed to get this down to 0%, no difference. So far, so good. Another good measure of liquidity we look at is Bitcoin. It's a very good liquidity proxy. Last week, it showed some reaction. Today, it's suffering a little bit. Well, we keep an eye on it. Also, regarding liquidity, we know that the reverse repo has been drained out and the money has been put to work. This doesn't mean that we will have any cracks or problems, so it just means that there was a lot of liquidity parked in bank accounts, in money market funds, and this money has been put to work, okay? The cushion of liquidity is lower now, okay? Here we can see the bank reserves, they were going down. They were being hurt by the quantitative tightening, which has been suspended. And now the Fed has acted lately and moved this a little bit higher, which served its purpose to relieve stress in funding markets, but it is not enough to ignite a bull market on its own, okay? Another liquidity measure, we look at typical liquidity measures, M2, which the Federal Reserve publishes, has been growing 4.3%, which is very steadily growing. This is very good for Goldilocks, because whenever the economy is growing on a too hot of a pace, central bank starts to get worried and raising rates, and the money flows from financial markets to the real economy. So a Goldilocks-like growth for monetary aggregates is good. So here I see it as more bullish than anything. Calm waters, as we could say. Uh, but the thing is, if regulators allow banks to use more leverage to buy bonds, then they will probably buy more T-bill issuance, therefore monetizing it just using further leverage, if not new money. Then this M2 can start growing at 7-8% clip, which is not compatible with 2% inflation. So far, this is not happening. So far, it's okay. So far, we are still at the 4.3% clip, which is compatible with inflation targeting, but we have to be watchful of this, okay? Total bank credit also on the 5% area, in line with nominal GDP. Another one which shows a probable Goldilocks scenario for equities. We mentioned last week total debt balance and its composition, mostly in the US, mostly comprised of mortgage securities, 70% of total private debt. And we also observed that gold is, if you adjust the price of gold by the M2 throughout the years, we are reaching the price highs of 2011. So this brings us some caution here. We have sold some of our gold positions, and now we are selling some of our silver positions too. And we have to be watchful of the dollar because economic numbers have been coming out. People still expect, the market still expect rate cuts, but with these 4 to 5% GDP numbers, I'm not so sure. And the dollar may react higher if this scenario really consolidates of higher growth. But so far, we can see it's completely sidelines here. I think 100 level is the key. Go through and perhaps try to ignite another wave of buying. But so far, even though the numbers are coming out stronger than expected, people are afraid of Trump doing something to weaken the dollar further, okay? Forcing it down. For the next meeting in January, the odds are almost 100% of no changes. Target rate remains 350, 375. 2 weeks ago, we had like 0.5% of lowering 25 or more, and 0.5%, 50%, right? Half probabilities of staying put, not moving. Then next week, it moved towards no changes, 71%, and this week is even higher. It's almost 80% going through March with no changes, okay? But when we look at December, December still the highest probability is cutting 50 basis points till the end of the year. And if we sum 50, 75, or just 25, we are already talking about this is 50, this is 78, almost 80% of chances of at least one reduction, okay? And mostly on the 50. If these probabilities start moving to the right here, and this will probably affect the dollar, will probably push the dollar higher, okay? If we see the right tail patterning growing, the chances of no more cuts going up, the dollar will probably move on that, okay? Here we can see that there are GDP now, the nowcasting done by the Atlanta Fed, 5.3% with the next number. This is a real strong number. This is volatile, but anyway, it's pointing higher. We can also look at New York Fed staff. They also do a new cast. Theirs is less volatile, but it also moved up from 2.6 to 2.71. For an economy the size of the USA, 2.7% real growth is a lot, okay? So personal incomes is still growing at a steady pace. Last week we saw nominal 4.5% nominal growth in wages in general. So it's still a healthy consumer. Regarding inflation forecasting, as I said, numbers are expected to drop a little bit in January, both PCE and CPI, especially the headlines. But break-evens have moved a little bit higher. I think that all this turmoil in gold and silver market may start waking up some of the bond vigilantes. So, and also better growth numbers. Those are the two factors weighing here. And so we moved from 228, which was a very benign number, to 233. And now I place a yellow flag there. It used to be green, it used to be a gold, now it's a yellow, have to be watchful. And if we ever break this 250 level, then I think the market will sell off, okay? You can see the 10-year breaching the 420 area and moving higher. We haven't seen this level since September 3, 2025. Also, tips are higher, 188. This week we have a big auction. The Treasury is going to be auctioning tips, FRNs. And the thing here is, whenever nominal rates are going up, but tips are also going up, both rates are going up, we have America strong, okay? So it's a strong economy, real rates go up, equities go up, currency should be going up. It is a strong economy. It is an economy that is raising rates out of strength, not out of weakness, which will be the case of nominal rates going up and tips having its yields falling. This is not the case. Both are going up, okay? Private credit spread still very benign, trading near the lows. We see here it's also a supply and demand case because government has been cleaning all the debt from the private sector since the 2008 crisis. But still, they were very popular during the time that the Fed was raising rates because you could earn an extra yield on top of a higher rate, so it was very attractive. Still, I can't see any crisis without this spread moving up much higher. So the way it is here, there's no crisis signaling at all so far, okay? This is a junk ETF, classical uptrend textbook, trading at the highs. This is the price of equivalent of a junk bond. This is the ETF that has a portfolio of junk bonds, JNK. So we got from JP Morgan economic calendar. Today is a holiday. Tomorrow we don't have anything. Wednesday, lead indicators. Speaking of them, it's been a while since they have been last release. We'll also observe pending home sales, construction spending, 20-year bond auction. Not a big, 13 billion. Wow, medium. We will have on Thursday, core PCE deflator, which is very important. We will see what is the real GDP, market expecting 4.3%, strong number. We also observe auctions of 10-year TIPS, 2-year FRNs, floating rate notes, for those who don't know what an FRN is. 2-year note, big one, 69 billion, and 5-year, another big one, $70 billion, okay? And on Friday, we have manufacturing PMI and services PMI, another two other numbers that can move the market. Talking about equities, this week we see only 6% of S&P 500 reporting, but the next week is going to be major one, 33% of companies reporting, and then 23. Also for European stock 600, the next 2 weeks are going to be very important. This one is still companies are reporting, but not as much as in the other 2 weeks that will follow. Okay. So here we remember from other meetings that expectations for earnings per share on the S&P for growth north of 10% still. The US has been leading in terms of earnings per share growth. NVIDIA still trading above the averages, everything fine here. MicroStrategy, the last week showed some sign of relief, some buying with volume, but it touched the 2 standard deviation line here and came back. Still trading above the averages. We'll see what happens. Looks like it's trying to form a bottom here, or perhaps just sidelining. We'll see. It will depend on liquidity from now on, especially dollar liquidity. We know that January is tends to be on average a good performance month for equities. The S&P 500, another textbook upward trend, still higher than the averages. Today we have a little bit of a stress on thin volumes, okay? When we compare the S&P with real money, with gold, the S&P looks a little bit sold off, stretched to the downside, but I wouldn't use this indicator much now because gold has been living on its own story. Interesting here is to see the equities versus bonds ratio. You know that the government has been issuing a lot of debt to finance the deficit, but this here also signals America strong. So you have rates going up, equities going up, the economy can withstand higher rates. So this is America strong, okay? The small caps also trying to stage a rally here. KBWB, we also observe it because big banks, big banks are the blood vessels of the economy. They distribute credit, whenever their shares are doing well, it means that the real economy is probably doing well. People are paying back their debt, and this is a bullish signal. Regional banks the same, and also home builders. Home builders have gone up sharply with big volume. This is looking like a strong graphic for me. Another bullish signal for the real economy. Walmart, another stock related to the real economy, is doing very well. Another positive. One thing to be cautious here is that when you adjust the S&P by the M2 money supply, it is reaching the peaks of 99 and 2000, the so-called internet bubble. But anyway, it just raises some caution on our side, but it doesn't mean that we will see a crack or anything like that. I think liquidity will be more important, liquidity dynamics and credit dynamics from now on. Those are still very benign. The VIX trading almost at 16, still a low level, and realized correlation has been on a downward trajectory, which typically happens in bull markets. Now asset managers will start having to look for different ways to generate alpha, run the risks of decoupling some sectors, stuff like that. So this is the typical behavior of times like this. And now going to implied correlation. Implied correlation is still at a very low level. So an index that should range between 0 and 1 is trading at only 13. So this means that the index options are cheap relative to the rest, and we have to be slightly cautious because this has been a very good contrarian indicator. Market is not stressed at all if you look by this measure, okay? So the conclusion for the US is strong numbers, rates may go up, equities can sustain the rally still, but watch for changes in monetary aggregates and possible inflation shocks ahead in order to reduce risk. The timing is not now. We also have to watch liquidity, because if liquidity drains, we also have to reduce our risk. But it doesn't seem the case so far, okay? Because it is more of a Goldilocks slightly bullish stance, but you have to be careful because of prices. Prices have gone up a lot this year, so this inspires some caution on our side, okay? For international, we know that Italy has been upgraded. Italy used to be the ugly duck in the past for fiscal issues. It's amazing how they change it. So now they have a lower implied rate if you compare to France. Italy has 341, 342. France has 351. It's been a while since we last saw it. The French equity sold off a little bit this day, but they still keep the upward trend. And now we go to China. So we know that China, their liquidity injections have lost momentum recently. So we have to observe commodity price linked to China. This is iron ore, suffer a little bit, but still on a very, very bit. Bond yields with the GDP number came down a little bit this morning, still very low levels. Their currency won't stop appreciating. We know some common market analysts like Gabe Call say that the only thing that is cheap nowadays is Asian currencies. The market probably following it because it keeps going lower. We know that China has a big trade surplus, just in goods. I think it's more than $1 trillion. So it's colossal numbers, okay? Their stocks are going up. Cross-border capital thinks that this is the beginning. They are on the beginning of the reflation trade after worries of a collapse in the economy, uh, give a leeway for the central bank to start easing, then we ignite another bull market, okay, another reflation trend. Emerging market index, US dollar index, suffered a little bit last week, but still behaving very well. Today we have the currencies appreciating, so this is not an issue. Uh, Euro versus Norwegian krone trending lower doesn't mean the market is much worried about oil. UK 10-year saw a big drop after better than expected inflation numbers, and now uh, correct a little bit following the US. Nothing much to see here. The pound, same thing, not moving anywhere. Germany 280, not much to see here. I would just be wary of the 290 level. If we break it, we may see some stress. And the DAX was doing new highs, came back a little bit, still a bullish figure here. The euro, same as the other currencies, very sidelined, not going anywhere. And then we have the case of Japan. Growth, nominal growth is negative. Money supply negative to the tune of 8%, which is a lot. And their rates keep going up. Situation here may spin out of control very soon if this doesn't stop. We have to see what happens, okay? Dollar yen also on the bid, but here is a major resistance area, and people are afraid of buying here because they think that the central bank may intervene selling dollars, okay, at these levels. This was, I think, 162 in the past. For equities, still very well bid. The market equities are being seen as a monetary hedge inflation. Also, no more leverage, no more debt in the Japanese balance sheet, so this helps also. Oil, we have this discussion in that Trump says he's acting in order to increase supply in the future and lower prices. But some people say that his actions are actually raising prices short term. We don't know. My best guess is that oils and other commodities are cheap and may react to the upside sometime soon. Okay, sooner than later. Why is it? Because in real terms, we are lower than COVID for oil prices, and the world economy is still growing, so it doesn't seem too right for me. Okay, gold breaking new highs after new highs. Geopolitical tensions, the threat of wars, monetization, name it. Copper, same thing. Copper is more of an industrial asset. It's been going up. Has also to do with the electrification of the grid. Steel is another steady market. China is not doing much, and other countries also following. And we have a very stable steel market trading around these levels, okay? Aluminum seems that it felt market has a memory, huh? It felt resistance here from way back September 32 and dropped a little bit. And silver is entering into its mania phase. It went from 40, 45 to 90 very quickly. It reminds us of the 1980s. Whether soy is still behaving laterally, also moving laterally, which is good because if we saw food prices on the rise, we would soon start seeing some revolutions and riots because this is what affects people the most, especially in big areas. So this is the wheat in USD. And then we go Brazil. Well, we didn't even have to update the slides. Characters are the same. Lula is still a very favorite. Nothing has changed. We will need some news to move that needle towards one of the candidates. Okay. So valuations remain attractive for Brazil in multiple terms because earnings have been growing up. But with regards to risk premium, when you take the earnings yields against real rates, because real rates are high, then the spread doesn't look too good. Okay. Well, we saw that there are some emerging market funds flows for Brazil. And this is the picture of this year, foreigners buying from institutionals, still the same of last year, right? Here we have JP Morgan, we also have Goldman Sachs, I think Bank of America also. Everyone has a call that the Selic rate will not stay at 15, will go to 12%, 12.5% some cases, and JP Morgan has 10%, which is a little bit more aggressive. Anyway, it's their opinion. But December tends to be a week with lots of dollar buying, lots of pressure. It wasn't different this time. The flow was still negative. Cumulative flow 27. And here we have the real graphic. Mighty real, okay? So this is typical end of year dividend remittances. It sees came all the way back down because it's expensive, as we will show later on, to be long dollars against reais. Okay. So here we do a small exercise. We try to value the dollar real pair, use just monetary indicators. We don't use productivity, any more sophisticated stuff. But first slide here is investor who exchanged dollars for reais in 2005 carried it in the Brazilian real overnight rate, funding it through Fed funds. Okay, so it's overnight against overnight. Break even has moved from 3 to 15%, which means gains are astronomical. Okay, the actual FX rate is here. The break even is up here. If we just use money supply M2 to adjust, I start from different points in time. I like to, first one is after 2008, when all the interventions began, liquidity injection, etc. So in blue is the actual FX rate. In red is what it should be calculated starting from this point. So here we used to have a 260 real. It could easily be 574, close to where it is now, and the market is trading at 545. If we start from the lows of 2011, when a lot of dollars were pouring in Brazil, the 162 reached here will be 312. We are trading at 440 now. But interesting to see. Since COVID, we have abused more. We have created more currency. Then, if we adjust from the beginning of 2020, which was trading at 425 rate, we could easily see 7 now, and we are still at 545. Another way to see it is that since May 2018, 100 reais have expanded to 265 reais, more than double. Whether in the US, it has only moved 57% up on a lower expansion rate. But the thing is, on the other side, it was very simple. The Brazilian real, the central bank creates more currency, it should weaken our currency. The US creates currency, but creates on a lesser pace. Then, as we saw, it should be bad for us. Okay, more money circulating. You know what? We know how it is. Okay, but then I was thinking that perhaps not only the quantity of money that matters, but it's whether investors are having an advantage carrying that currency or not. Meaning that, for example, money supply is growing at 5% a year in monetary inflation. Monetary inflation, not cost inflation, not CPI, not PCE. It's monetary, okay? But the overnight rate supposedly is at 10%. So you are still earning 5% clean, okay? That I would call a contractionary area where overnight rates are higher than the monetary expansion, the creation of currency. So this should cause our theoretical exchange rates to strengthen. It started at 100 and should be strengthening towards 80. Then in Brazil, there was a big intervention in 2008, a smaller one 2009, 2011. It was the last bull market for real estate and equities back then. We would see another one just after Bolsonaro was elected and COVID came, where things really spiked, and then our theoretical exchange rates will be corrected higher. Now we are approaching contraction zone again. This is reacting lower. Interesting enough, you can see Brazil is more volatile with sharp contractions and expansions, whether the US has been going on a steadily pace, which was heavily accelerated during COVID, and the authorities had to react and contract money supply and raise rates in order to put inflation in check. But it is interesting that when you discount for rates, Brazil has diluted its currency less than the USA. 100 in 2002 should be 155 now, whether in the US 100 now would be 257, but on a slow, steady pace. I think probably this is the reason why probably rates, real estate and equities keep always climbing up on a steady pace, different from here, which is a typical commodity market where you don't have much clear trend, but sharp movements on both sides, okay? And here it's a graphic that mixes the two. So in red, we have the US, above zero is expansion, below zero is contraction. With the US, we only had a contraction from 22, 23. In Brazil, we have several contraction and expansion periods. You can see that contraction, the dollar exchange goes lower. Expansion, dollar exchange goes higher. COVID expansion, both did the same, but Brazil doesn't have as much credit and and its currency suffered. And here we were trying to get into an expansion in a possible inflationary scenario. The market reacted. Now the central bank did the right job, pulling the Selic up. We are contracting, and we are seeing the FX, the foreign exchange rate, going down. This is the same graph, but more zoomed in from 2012. You see Brazil, the blue here, is starting to contract. US was contracting, now it is expanding at a small pace, very small. But here comes a conclusion, which is very interesting. If you were to adjust using only the difference, then the real should be strengthening, not weakening throughout this all this calendar here, this 20-year calendar, because we have sharper expansions, but we also have sharper contractions with rates going much higher. And then it is very costly to carry a position against the real, especially funded by dollars. Sorry, it's hard to be long dollars, especially if you're funding through reais. It's better to be invested in reais. And this graphic clearly shows it. In green, you see the real exchange rate, the actual exchange rate. But in blue, they started the same point in 2002. In not blue, this is purple. In purple, you can see currency should be appreciating. So that's one of the reasons I'm very skeptical of buying too much dollars here. It can be very costly, and some factors point towards depreciation of real. The others point to appreciation. But the fact is, this is a costly bet to keep. The government spends a lot of money in interest payments, but it's been like that for 20 years now. We'll see what happens. So for Brazil, you know that Brazil has a recurring primary result of 1%, and the government may find some extra revenues in order to make it zero. But because we have high interest rate payments, we can reach 9% nominal GDP, which is very high, opposed to the USA, where primary result is much more negative, 2.5%, but nominal is smaller because rates are smaller. Nominal for US is 6.5 to 7%. Nominal GDP moving down, close to 8 and 9%. Selic at 15% may be too costly. That's why market forecasters are considering Selic reductions in their scenarios. And the average inflation since real, IPC inflation since real devalued in January 1999, which was a while ago, 6.25%. The average CDI, 12.5%, so we're still higher than the average. Monetary base M4 criteria, 13%, okay? And since 2016, 17, when Dilma left, the numbers are smaller, but they're probably climbing higher, especially CDI with this 15% for a while, okay? Still, the average is lower. We're gonna do another track with short videos, but one of the themes is gonna be this one. Because of this expansion contraction pattern that we see in Brazil, this probably may affect real estate prices lower than where they should be or could be. And when we divide some benchmarks for real estate prices by the monetary base, we can see that there's an opportunity here. This is the asset that we like the most nowadays in Brazil. Some exchange traded funds are showing very depressed square dollars per square feet prices in reais and in dollars, okay? And so we see this as an opportunity. We are loading up on some funds okay, here. Here I can see my ratio. I make a joke here. Uncle Domisa ratio, expansion, contraction. You can see how this affects the rate of expansion of prices of real estate. Implied inflation rates for Brazil, even though current rates have been very benign, the readouts from Focus all going down close to 4%, but implieds have been climbing. There was some stress on rate futures last week. So this is DI future for January 33. Not very good sign here. Lots of volume and going higher than the averages here. Not very good technical sign. And this is January 27, where we do an exercise. See, the market was pricing 12.25 a while ago. It even reached 11.90 Selic at some point. Now it's going back to 12.50 with less weak stress. And if central bank lowers rates like the way that we projected here, 15 March, 75, 75, 50, we can earn 66 basis points by selling January 27. If this materializes, we don't know if it's going to materialize or not, but if it does this way, there's some room to make money here, okay? Bovespa keeps grinding higher, especially because of Vale and some commodity producers. I wonder what will happen when oil producers start climbing, if oil prices move higher, because this is the only part that is still lagging on the commodity atmosphere. Commodities tend to be bullish at this part of the liquidity cycle. So this is benefiting Brazil. You can see that EWZ is on a bullish trend, higher lows. We are still cheap with regards to emerging markets, the whole emerging market ETF, the EEM. With comparing to gold, it's a massacre. We are very cheap. Against Mexico also, we are approaching the lows, so another reason to be long Brazil equities, or at least on a long and short basis. Versus small caps in the US, long term also cheap. And here we look the small cap index against CDI, implied CDI. On average, not cheap, not expensive. On the longer term, I would say cheaper than expensive, but close to average too. Corn seems to be forming a bottom here. Corn is very important for the food chain, inflation pressures. See what happens. And coffee, for those of you who like drinking coffee, espressos, good news. Coffee prices have been going down lately. So for Brazil, we still have cautious, market is still cautious with fiscal woes. Market is still expecting what will happen on the elections, any signals of who is going to run, representing the right, still not certain. We'll probably see lots of volatility going forward, and but valuations and rates are still attractive. We'll have to be careful because volatility here will be high, okay? Uh, if you have any questions, please contact us. Subscribe and link and like our channel. We thank you for your audience. Everyone have a good week and good luck in investing and trading. Bye bye. Thank you.